or good morning, depending upon where you are. We are delighted to welcome you to a new version of our edition of our monthly seminars. This one's going to be on value investing. We're looking forward to share some ideas and thoughts with you. We will entertain questions and comments near the end. Because it's a webinar, we would kindly ask you to put that into the Q&A section and we will field them at the end. Fortunately, who am I? David Dietz, Managing Principal, Senior Portfolio Strategist. But just as importantly, I'm joined by my valued colleague, that would be Donna St. Amant. Donna is a Managing Director and Portfolio Manager with Peapack Private, and works with our clients on all sorts of topics, including portfolio construction, investment implementation, management. She spent over 20 years in the financial services industry, focusing on wealth management, fixed income, and credit products. Prior to joining us, she held senior positions at Bank of America and Merrill Lynch. Donna received her MBA from Columbia Business and has an undergraduate degree in finance from Villanova. They're not just known for basketball. There's a lot of good stuff going on at Villanova. Donna, welcome.
Thank you, David. Thank you, everyone, for joining us today. A couple items before we start. We will be providing a replay of the webinar to all those who have registered. And we actually have a poll question today. The poll question is, which strategy do you think is more appealing, value or growth? So if you can answer the poll question, and at the end of the presentation, we will share the results. Okay, I guess we're ready to get started. Do you want to hit the slide, David? Okay, great. For those not familiar, we are Peapack Private Wealth, the wealth management division of Peapack Gladstone Bank with 11.1 billion assets under management. We provide customized investment management and holistic financial planning for individuals, families, and small institutions, and we manage for tax efficiency and transparency. So I am going to send it over to David to get us started.
Thank you, Donna. So I want to first explain what I think value investing is. Value investing, in our view, is trying to get the most profits from a company with the least investment outlay by you as an investor. A value investor carefully analyzes for each dollar you're putting into that investment, what's the most dollars of profits, cash flow, sales, and free cash flow you will receive in return. So one of the deans of value investing was Benjamin Graham, and he likened this style of investing to buying your groceries. You know how on the shelves in the aisle at your favorite grocery store, they have little signs. They indicate for each brand or size of a product, how much you're paying, let's say, per ounce or other unit of quantity. So a typical value investor is going to look for how to get the most units of quantity, ignoring that pretty label or that new and improved puffery on the sign. Similarly, a value investor is skeptical of a little size container of the national brand, preferring to head to, say, a Costco and get the huge box of the house brand, realizing that on a per unit basis, the investor is paying substantially less. So another key attribute of a value investor is to prefer one in the hand versus two in the bush. That means preferring an immediate return on an investment versus a deferred return down the road. While, two in the bush sounds good, it might be nice, value investors keep a healthy degree of skepticism as to whether the two in the bush will actually materialize. Stories of eventual profits and largesse are looked at with skepticism. Well, why is that? The future is always uncertain, so that's one reason value investors prefer that one in hand in the book. Second, buying into the two in the bush story usually requires paying up, paying more, and if that promise of growth doesn't materialize, you're going to be risking loss of principal. So value investors particularly like trouble situations, particularly issues where the trouble is short-term in nature. Many investors tend to overreact to bad news. shooting first and analyzing later. And even though most bad situations will pass. And so you can take advantage of knee-jerk pessimism to get otherwise solid businesses on the cheap. Examples of bad news that can cause overreaction in the stock price are strikes, litigation, personnel changes, travails happening to other companies in the same sector that may not have a direct bearing on the company you're looking at. You can be more confident on buying on the dip if the reason for the dip will not last forever. Value investors also look for a margin of safety. If you're trying to buy a company at a valuation that's less than the valuation of the overall market, if it's a lot less in the market and things don't work out great, you may still end up with a company that is not as cheap as you thought it was, but still cheaper than the overall market. So if the overall market trades at 20 times earnings and your prospective investment is at just 10 times earnings, even if the earnings don't materialize quite as well as you had hoped, you may still have a company trading at 15 times less than the overall market. At this point, let's go to the next slide and turn it back to Donna.
Great, thank you. So countless studies have shown that value investing does work. Buying stocks at a discount provides better performance relative to buying stocks at a premium. And really, if you think about it, it just makes sense. No matter what you're buying, whether it's a stock or real estate or art, the less you pay up front, the better that is for your returns. So you can see in the chart that over the long term, history does favor value. Of course, shorter periods of time, anything can happen, and there's definitely volatility as we have seen, this year. And of course, no strategy works all the time. Value stocks have not been great performers in the last decade, although the record is starting to improve recently. And indeed, so far this year, value stocks have outperformed. Now, value investing is not the only strategy. Other types of strategies can work well too. But whatever you prefer, you don't want to chase price performance. This is a fairly common mistake made by investors, but it really doesn't make sense that you're more bullish on an investment because the price has gone up, or you're more bearish because the price is going down. If the fundamentals are the same and you could buy the stock for less, this really should be an opportunity. Next slide. What are the tools of the value investor trade? Meaning, what specifically are investors looking at to make their buying decisions? So value investing is based on the numbers, statistics, valuation measures, financial ratios. It's not about the best story or the latest concept or a future technology. It's about profits generated, sales realized, cash flow, different from a growth stock strategy where much of the stock price has expected future growth priced in. So cash is an important measure to consider. Look at free cash flow, the cash the business operations are generating that can be distributed to owners and shareholders because it's not needed to run the business. Look at company sales, also important. Perhaps the stock price is down because profits are under pressure. But if sales are strong, you can get a sense of the value of the company. They may be able to cut costs to improve profitability. So again, this would be a buying opportunity. But it's important to consider all factors together to evaluate the company, not just one metric alone. Another point you want to consider is the industry that the company falls into. You can't always compare a financial metric from one company to another in a different industry. It's important to consider how this impacts your numbers. For example, consumer products companies advertise heavily. This expenditure is immediately subtracted from profits, but unlike some expenditures, should provide benefits in succeeding years. Same holds true for research and development costs for tech and healthcare companies. They're deducted immediately from the profits, but will have benefits down the road. And then finally, stability and risk around the company operations must be kept in mind. So how much debt is being employed, for example, or what is the size of the company and the length of time in business? What is their market share? I will now hand it back to David to review the ideal investment for a value investor.
Okay. So what is that ideal investment? Well, like most things in life, no investment is perfect and everything involves some trade-offs. Numbers are always on a continuum and there are many shades of gray. Plentiful earnings are a must relative to your investment outlay. However, if the price to earnings metric is the same for two different companies, the company with the greater market share, the lower debt level, with less cyclicality in its operations, that has a better chance to grow those earnings may be the more attractive one. Unfortunately, the price to earnings or PE levels of two different companies are never identical. So the question can come down to how much less in the way of earnings will you accept per dollar of investment outlay to get that lower debt level, that lesser cyclicality, that higher market share, and or those better growth prospects. To make it more complicated, some of the flaws in your proposed investment may actually be opportunities. The company with the lower market share may be able to more easily increase its market share, while the company with the higher market share may have less chance to grow it, and perhaps may be targeted by regulators for being a monopoly. The company with the extra debt may be able to pay it down, while the company with the smaller debt may be incentivized to go on a spending and borrowing spree. You know, the quality of management is frequently cited as an issue. To go back to Benjamin Graham, that Dean of Value Investors, he always ignored management's reputation. How so? He reasoned that if management was so good, it would already be reflected in the numbers. So to pay even more for the stellar management was double counting, overpaying. And if the numbers weren't that good, how deserving really is that management's reputation? Hey, another reason for not paying up for the so-called celebrity CEO is that situation can change fast. I tell my clients that the only thing worse than investing in a company with poor management is to pay up for a company with a star CEO, only to see that CEO depart after you've made your investment. So, you know, where are we going to look for value? There are many places. They don't all involve just setting up your screen on your computer for low price to earning stocks. Consolidated or conglomerate companies can provide opportunities. They may not appear on a conventional screen for value investments, since the parent company's earnings may not fully reflect on its financial statements the cash flows of valuable subsidiaries. Or a company has several businesses within it, and its overall valuation is being depressed because investors want to steer clear of, say, one of those businesses. Or each of the component businesses may have better prospects if they had their own stock and independence, thus motivating better the managements of each of the component companies. Sometimes investors steer clear of a conglomerate because industry experts can understand one of the components, the one in their industry of expertise, but are uncomfortable analyzing the components outside their area of expertise. Companies may, under those circumstances, be motivated to unlock their value by separating the businesses. Savvy value investors can anticipate and then buy the conglomerate in advance. The trick is to value each of the components as if it were a standalone enterprise, add them up, and see how the sum total compares to the current stock price of the consolidated parent. We also like discounted closed-end funds. Closed-end funds are a bit of a hybrid between an open-end fund and a so-called exchange trade fund, better known as ETF. Like both, they pool the money of investors and have an investment objective. They are virtually always actively managed. Like ETFs, they trade all day on the exchanges. However, the funds themselves are closed, meaning for an investor to get in or get out, it must find a willing party to be on the other side of the trade on the exchange. Like a publicly traded company, closed-end funds have no responsibility to make a market in their shares or redeem their shares or issue new ones. The opportunity comes when the market price of the shares becomes significantly less than the net asset value of the fund's holdings. Value investors can jump in then and profit from growth in the value of the internal holdings within the fund and or a closing of that discount versus the net asset value. You know, what happens if the discount never closes? you're actually still better off because the discount represents the equivalent of an interest-free, non-callable loan for part of your investment. What are some of the pitfalls? Well, the discount could widen. Closed-end funds have a relatively small market cap, so liquidity can be an issue. The holdings may have significantly embedded unrealized capital gains. If realized while you hold the shares, you could have unwanted capital gains distributed to you, a problem if held in a taxable account. The fund may have relatively high management fees, which nevertheless can be justified if that discount is wide enough. And finally, many closed-end funds, particularly fixed income ones, are leveraged. Leverage can magnify gains, but can also make that fund more volatile and could hurt returns in a rising rate environment. Now back to Donna.
Thanks, David. Aside from the merits of a company itself, an equally important piece of selecting a stock that will deliver superior returns is the price you pay for that stock. Market sell-offs offer opportunity to value investors, and smart investors should always be on the lookout for a chance to buy their favorite stock at a lower price or on sale. So the market will see 5% sell-offs regularly. 10% sell-offs or market corrections typically happen annually or more, and 20% sell-offs or bear markets happen at least every 5 years. So these are all good times to buy the stocks that you believe are solid companies. Perhaps you're very positive on a company, have done the research, you want to buy it, but it's just too expensive. When the market takes a downturn, this is when you can add it to the portfolio. And you know that because the entire market is selling off, the shares of your selected investment are down in sympathy with the market, and most likely not because there's a problem with that particular company. So when the market returns to normal, so should the stock price of your selected investment. And this not only holds true for the market as a whole, but for individual business sectors. All stocks in a particular sector can trade down due to an industry-wide issue, say the bursting of the tech bubble in the early 2000s, the financial crisis, or energy during the pandemic when oil prices were under pressure. So these are sector events that drag all stocks within the sector down, regardless of company-specific issues. So look for the strongest companies in the sector. Of course, you're going to evaluate the situation, but companies that you've wanted to buy that were too expensive, you can add during the sell-off. And the same approach can be applied to a country sell-off or a sell-off in one particular sector of the market. They all can provide buying opportunities. And now I'll go back to David to wrap it up.
Thank you, Donna. So some popular value strategies that are well worth considering and are studying for additional ideas we will discuss here. Probably the most famous value strategy is the so-called dogs to the Dow strategy. A fellow named Michael Higgins in the early 1990s popularized it. And the strategy involves, at the start of each year, select the 10 highest yielding Dow components, invest in them, sit with them for a year, and rinse and repeat at the start of each year. So the value logic behind the strategy is that high yielders represent better value for your money, with dividends being a very rough proxy for the cash flows being generated by the business. The higher the dividend, the higher the cash flow relative to the amount you're investing in. That strategy has outperformed, although as we cautioned earlier in the presentation, not every year like most value strategies, and indeed has underperformed for multi-year periods. So even if you're not prepared to go full dive into the entire dogs to the Dow strategy, it may be worth pursuing the current dogs, meaning the top 10 yielding stocks in the Dow, at whatever time of year you happen to be wanting to make an investment, to see if they merit further research as a possible value investment. Of course, every strategy has its critics. Often critics will say, well, they're in that category typically not because they raised their dividend, but because the stock price went in reverse, leaving that dividend as a higher percentage of the stock price. However, Dow stocks are larger, typically well-seasoned, and thus typically have the resources and skills to address whatever the problem was and ultimately have investors award it with a higher stock price. Remember, of course, if you turn over your stocks at the end of each year, if those are held in a taxable account, that may not be a tax efficient strategy. Also, dividends, of course, can be a proxy for the undervalued metrics at a company, but not necessarily. So that you want to use the dogs as an initial screen, not a definitive buy list. You want to investigate further. Another value strategy is to look at spin-offs. Companies typically spin off divisions or subsidiaries if they become a distraction to management, have poorly perceived growth opportunities for that division being spun off, or if a streamlined company will garner a higher stock price. Investors who own the parent stock often immediately sell whatever they get as a spinoff, believing that the spinoff is not consistent with their initial investment objective in terms of owning the parent, and or thinking that, heck, if the parent didn't want it and spun it off, why would the investor want it? Value investors, however, can swoop in, reasoning that at a low enough price, anything can be profitable. If investors often miscalculate on what is or is not going to grow, quite frankly, the management of parents can also make those mistakes too. And to the extent investors are selling off the spun off companies simply because it doesn't fit with their portfolio strategy, that could be an opportunity. The spun off companies' prices are going down due to the sales, and the selling is not due to any fundamental factors involving the spun off company that would affect its intrinsic value. Simply, it's due to extrinsic factors involving portfolio management. Now, we've got some good questions in the Q&A box, but before we get that, and that is the conclusion of our formal program, I'm going to invite Donna to share the poll results.
Okay, we have a slight preference for the value strategy. We have 62% of the respondents choosing value and 38% choosing growth.
Thank you for that, Donna. I wonder if that changed at all during our presentation. In any event, we do have some good questions here, and we've got one on the Walt Disney Company. Is it cooked, overvalued, and so forth? You know, Disney is a company in transition. So it's got that great content with all sorts of world-class studios and various entertainment that they're developing. They have, of course, their iconic theme parks. And of course, they're starting to reopen now, and tourists are flocking to them. That's a stronghold there. So the issue is, how is that world-class content being viewed? And increasingly, instead of looking at traditional TVs and going to the movie theater, people want to pull out that handheld and stream it right on their phone. Well, Disney's got a solution for that. They've got their new Disney Plus product. And indeed, consumers worldwide are flocking to it. The challenge, of course, is they have some stiff competition. And competition number one would be Netflix. So they're having to invest heavily to keep the price down, to attract the viewers and build up that business, which they view and many other people view as the way content will soon be overwhelmingly consumed. So your problem is the business is growing very fast, but the earnings, quite frankly, are depressed, giving it tough price to earnings metrics. So obviously, all things being equal, you know, the value investor is going to say, I want to see my return now, not 3, 4, 5 years down the road. Having said that, Disney has a long, solid track record. They've got that world-class content, and the stock was close to $200 within the last year and a half. Right now, is off at least 25% from that, so you're not buying at the top. So I think it's got that value component because you're well off the all-time highs, but it's certainly got that growth component because you have to be very certain that they will be successful with the streaming and they will fight off the competition from Netflix. And quite frankly, there's a host of other would-be streamers getting involved too. So that's what you're betting on with an investment in Disney. Okay, we've got another good question here. Big MO, that would be Altria. You're best known for the purveyor of the Marlboro cigarettes in the United States. So, you know, with a dividend, which is in the high single digits, it's probably a quintessential value name. You know, you're going to get a return if nothing happens to the stock price. It's still what, 3.5 times what you would get on a 10-year treasury. And historically, they've been successful in raising that dividend over time. So whenever something looks too good to be true, there's always another side of the story. And as we all know, the incidence of smoking is going down, not just in this country, but worldwide. Well, the flip side, of course, is that Altria has a solution for that. They've got all sorts of new smokeless tobacco initiatives, better known as vaping. And of course, they have investments in other lifestyle products. For example, they own 10% in Anheuser-Busch, which is your largest brewer worldwide. That's a world-class company. And of course, they have all sorts of investments in various vineyards and wine purveyors. So it's definitely a value stock. If they are successful in transitioning the business to offset loss in traditional smoking, I think investors will be well rewarded. There's probably also a discount because, quite frankly, it is not considered you know, a socially responsible type of investment. But for those who can overlook that and the price is lower because other people won't look at it, maybe that gives you a little extra return on your investment. Other quintessential examples our questioners asking about in terms of value investments. You know, certainly the energy companies are in that category. For example, you've got Exxon with over 4% dividend, which is #1 in its field. Again, there are real issues there as to whether those are socially responsible investing, given concerns globally on the climate. You know, on the other hand, as geopolitical developments have unfolded, we realize that energy is in short supply, and a transition to cleaner and more renewable energy resources is not going to happen overnight. And of course, a company like Exxon has an advantage because other would-be companies probably don't want to get into that area, or if they do, they're finding fewer and fewer investors to back them. And so they kind of have the field for themselves. So there's your quintessential value investment. Another one that you probably leads the pack is Verizon. The symbol VZ has the largest dividend on the Dow, one of the largest in the S&P 500. And here you've got, by many measures, the market leader in terms of wireless communication. We can't live without our phone. And for most people, that means having a wireless subscription. And for most people, that would be Verizon. They've got stiff competition, of course, by T-Mobile and AT&T. But most consumer surveys show Verizon is thought to have the best quality service. You know, the flip side, of course, is out of debt. They're investing billions to upgrade service to 5G, buying spectrum and so forth. That has to get paid back. But Verizon would be a quintessential value investment with arguably the pole position in that industry. So Oh, we got a great question here. How does timing play into a value investing strategy? Well, certainly timing is a word that can mean a lot of different things to a lot of different people, kind of like the word risk. But timing is important to the extent that if your ideal investment is at $20 a share and you get up in the morning and it's at 16 because of what you think is a superfluous news story that's causing some people who are very short-term oriented to panic, while people who can take a longer-term view will say, hey, I got 20% off here. This is the time. So there's timing for you. To the extent people are referring to timing meaning, well, there's a long uptrend, and even though your favorite investment is now double what it was when the uptrend started, they say, well, the line is going from the lower left to the upper right. It will probably continue. Therefore, it's time to get on. There, a value investor would be kind of skeptical and cautious, reasoning that, why pay twice what you could have paid before? And everything is cyclical. Remember, it may not a company doing quite well isn't going to just attract investors, but they're going to attract other competitors in the marketplace on Main Street. And as an example, you've got the Apple iPhone. You can be sure that every garage around the world has someone tinkering with a phone to try and come up with something better than the iPhone, because the opportunity is so great, while there's fewer people who are sitting around trying to come up with a new tobacco cigarette. So there's your problem with something that is doing quite well and trading at a very premium valuation. So if that's what is meant by timing, that would be something you'd want to be skeptical of. So I think we've got time for 2 more questions here. Let's see here. Is Hershey a value investment? Well, it is probably seen by most people as fully priced. On the one hand, of course, is chocolate and confectionery sales are not seen as probably a high growth endeavor. Consumption increases annually, but certainly not by double-digit rates. The way you might see in some sort of semiconductors or some sort of technology area. On the other hand, of course, you're not paying a nosebleed valuation with a company like Hershey. You've got a steady eddy there. I believe the dividend is slightly above the average on the S&P 500, but certainly not a Verizon or an Exxon or an Altria. So, that may come into the category of growth at a reasonable price. But certainly it's a fine company. Their opportunity to grow maybe if they can penetrate more overseas. And certainly over the years, large international confectionery companies like Mondelez have taken a run at them. But a large portion of their shares are held by the Hershey Trust and used to better the local community. So I think we got time for one more question. Would you buy more heavily in one particular sector because it's under pressure, and thus all stocks are cheaper as a result and more value? It's all about a risk and reward type of thing. Your number one principle, putting aside value and growth, is to stay diversified, because as we started with in the beginning, the future is always uncertain. So although a sector or a company could look great, a situation could develop which makes it turn into something less than great. And that, of course, can happen with a company, but it can also happen with a sector. So, for example, we saw at the start of this century people plowing into many tech companies. And then, of course, the bubble burst and people gravitated to looking for things that had a little bit more value, and the NASDAQ went down about 80% over 30 months. Certain areas like the tobacco area or the energy area or even the phone area, the whole sector is down. But as we know, there are, in terms of the tobacco area, macro shifts in terms of how people want to spend their leisure time, and it doesn't involve cigarettes. On energy, the sector's down, it looks cheap, but you have to confront the risk that government regulation, investor preference, and the need to address climate change is going to make all those stocks perhaps no longer have business down the road. How long down the road is probably anyone's guess. And so I think at the end of the day, you're best off trying to be kind of equal weighted on that. Donna, what am I missing here?
I think that's it. I would just say to anyone who's we didn't have time to get to your question, we can certainly reach out to you one-off and get those answers to you as well.
Thank you. And of course, we are always open and be delighted to have a personal review of your financial situation. You see our offices on the screen. And finally, we would like to thank you for taking time out of your day and attending our webinar. Thank you so much. Have a great day.
Thank you.